Let's bring in Ron Insana. He's CNBC senior analyst and I almost said secret advisor to Schroders. Senior advisor.
No, it's relatively public.
It's relatively public.
More than relatively.
Yeah, all right.
Absolutely.
And Jamie Cox is a managing partner with Harris Financial. Welcome to both of you. Ron, the president says he's paying interest rates.
Well, you know what? He's actually quite accurate about that. There have been reports that the Trump organization has about $340 million in adjustable rate debt. So might be one reason why he's paying more if rates are going up. But they've been coming down. And, you know, there's some cognitive dissonance here, guys, because when you look at what he says, it's the strongest economy in history, so we should have lower interest rates. That's not historically the way policy has worked. Now, granted, one could argue that there are external risks, that there's been some slowing in the U.S. economy that would justify the Fed taking back its December rate hike. But given today's numbers, the market was pricing in as much as a 50 basis point cut this month. That seems now to be a little too much to expect.
Jamie, the Fed doesn't know what it's doing, says the president. Does it?
I think the Fed does know what it's doing. I mean, if you think about it, in December, markets basically told the Fed, enough is enough. You're raising rates. If you continue, you're going to torpedo markets. And the Fed backed off. I mean, we haven't had a rate increase for 6 months, and the Fed has been talking about cutting rates. So I think the Fed has become a punching bag unnecessarily for the last couple of months because it seems like they're in this conundrum between should they cut or should they stand pat. And I think the data is unclear. I mean, economic data has been softer, but it hasn't been really bad. So I think that the Fed is probably going to give us 25 basis points to placate markets, and that's going to be it. And that honestly might be a little too much. I think that the economic data in the second half could pick up, and it could be that the Fed makes a policy error by cutting. So I worry that the error is more likely on the downside now than on the upside, given all the data that's coming through. Yeah. So I would be in favor of them doing nothing for July.
Jamie, that makes a lot of sense. And Ron, that's why if we're at the very least in an unclear situation, it seems like an odd time for the Fed to make a relatively unprecedented move by cutting rates in the middle of an expansion for a slowdown that hasn't materialized yet.
Yeah, I mean, I wouldn't go necessarily with unprecedented because you look at 94 and 95, you look at 97. Yeah, relatively. 97 and 98, there were policy changes that had to do with external shocks. Now, we are having a bit of an external shock insofar as there's $13 trillion of overseas sovereign debt that carries negative interest rates and are at record lows.
Or you could say the shock is tariffs and what's going to happen.
Correct,
and that's totally fair. And understandably, the survey data has picked up some softness. But again, we're talking about a rate cut.
Yes.
Now, if they phrased the whole thing differently and said, look, it's a strong economy, but there's no inflation, rates are too high for that situation,
right,
then there wouldn't be a problem right now. But they keep framing this as we will support the economy if needed. They don't say inflation's low, even though the economy's strong. I think they've boxed themselves in.
Or they're not saying, with respect to, let's say, an insurance rate cut, that we have a lot of overseas risk, whether it's a hard Brexit in October, whether it's further slowing in China because of the trade war, whether it's Italy having problems with the European Union, or a whole host of countries that are in or near recession that could drag down the U.S. They haven't been that, you're right, they haven't been that explicit about what they're trying to do.
Mohammed El-Arian last hour, when I said to him, Mohammed, after today's report especially, does that justify a 2% yield on the 10-year? He said, well, the German Bund is at minus 0.4%.
Yeah.
And that's fine, and he's right. But think about that answer. Should the U.S. 10-year yield be at 2% based on these fundamentals? And the answer is, well, but Germany's yield is as low as it is.
Well, I mean, what we think we know is that 10-year yield should be roughly equal to nominal growth, which is about 2%, right? I mean, you're looking at second quarter GDP somewhere between 1.5 and 2 is the estimate. Inflation's near 2, so the 10-year is about where it should be. Now, you've got an inverted yield curve for 6 months, which is also sending a message to the Fed that they should be doing something. But again, that could be happening for a variety of reasons. The U.S. economy is not near recession. The rest of the world doesn't look so hot.
So, Jamie, let me turn back to you. You seem to think that it's likely that there'd be a quarter-point cut either at the next meeting or the one after that. You question whether it's needed, but let's assume that it happens. And that's really all you can work on here as a portfolio manager. What should I do with my money? How should I react? What will you do?
Well, I think most everybody's already predicted that there would be some type of rate move. And even if there wasn't one, just the steady state leads you to a couple of conclusions. Over the past month, S&P 500 has, rocketed 3.5% higher than international markets. So I think what we've been looking at is that disparity between U.S. and international markets, a good thing. So we've been buying some international. In addition to that, we've been looking at the opportunity to rebalance in our fixed income portfolios. Treasuries have gone up a lot. And so this is a good time if you have a couple of treasuries that you maybe wanted to offload last year but kind of got caught off sides, this is a good time to do so. So I think that you're not going to look at markets selling off, but I think this is a really good opportunity to rebalance because in this uncertainty, this is where you get the chance to do these kind of things.